everyone, and welcome to my fireside chats within the context of corporate venturing. Today, it's my pleasure to have Gregor Gimmy join me from Munich in Europe, where the snow is slowly melting. And it's a pleasure to have you make time for us. Thanks very much, Gregor.
Thanks for the invitation. Looking very much forward to this talk with you.
And you're not a stranger to INSEAD, so you've done case studies with us. You regularly join us in class occasionally, so thank you very much for the support in the past as well. But today's topic will be, can corporates successfully benefit strategically from startups without corporate venture capital? So we will basically tackle the question on corporate venturing by arguing that corporate venture capital, meaning corporations acting like venture capital funds and investing usually the parent company's money in early stage companies, is not the best way to go ahead. Now, Gregor is the perfect person to talk to us about that. He's spent many years in Silicon Valley, started with IDEO in Palo Alto, went to Siebel, where he experienced the venture client model and was really inspired by that. And we'll come to the definition of that in a bit. He then joined BMW, German car manufacturer, and help them identify startup opportunities and find a way to get closer to the startup ecosystem. Is that a fair comment, good introduction for our talk today?
I guess what I did at BMW was based strongly on my experience in Silicon Valley, both at Siebel and also as an entrepreneur. And that experience helped me identify what really, the issue is around, or let's say the bottleneck around gaining strategic benefits from startups if you are in a corporation. And that led to the creation of what I call the venture client model while I was at BMW.
Okay, so let me put you on the spot. Mm-hmm. A quite well-known venture capitalist said years ago, corporates should not do minority investments in startups. He famously said, I hate CVC. I hate corporate venture capitalists. And I think maybe not as aggressive, but I think you agree with this. Why is that? Can you give me kind of your top 2 or 3 reasons?
Well, first and foremost, the strategic benefit really lies at the core of the invention of the startup. So if a startup invented a great technology to charge a battery in 3 minutes, then for any car company to use and adopt this technology, this is where the strategic benefit is generated, because if you are a car company that launches a car whose battery is chargeable in 3 minutes, then you have a competitive advantage, which will ultimately turn into more revenue and also more profitability, because you may be able to charge more for the car. Now, you need the technology of the startup to gain a strategic benefit. If that startup that has this revolutionary battery charging technology, which by the way doesn't exist at this point yet, if you own a minority stake in that startup, you have exactly zero technology. You have nothing. You have a bunch of shares lying on your balance sheet from that startup, but nothing else. Your cars have not become better. So the minority investment in a startup does not generate any strategic benefit. It is at best a preliminary step to the adoption of the startup technology. But as of today, that previous step, this middleman, the strategic corporate venture capitalist, is no longer needed. you can, if you have the right processes in place, approach the startup with a what I call venture client proposal to adopt this venture, the startup technology immediately and directly. That saves you a lot of time. But first and foremost, buying equity of any company does not generate a strategic benefit. So if you as a person want to benefit from the iPhone, you have to buy the iPhone, not Apple shares, correct? So
yeah.
That is a similar situation, correct? If you want to benefit from the startup, you got to you got to get the product into your company, buying a minority stake, meaning you don't have any control over any kind of technology transfer because you're not controlling the company. It means you just own a bunch of equity and you don't have access to the technology through that investment alone.
Right. So that's interesting. So owning shares in a company does not give you access to their IP, technology, ideas, or whatever skill they may have to execute. Now, obviously, you've spent a lot of time, you have a lot of experience in that space, and you kind of started developing this theory, if we like to call it. So when you joined BMW in 2012 in innovation strategy, you identified something that you called the startup gap. Can you tell us a little bit what you mean by that and why it matters?
Yeah, the startup gap is, I define it as a startup gap exists if you have a problem that a startup can solve best, but you're not solving it through the startup. You're solving it through a less good technology, or you're not solving it at all. Okay. And this is a startup gap. So the startup gap can be very small if you're missing out on startup technologies that are better than what you have. If the number of those technologies is very small, if the number of technologies that you miss out from startups that are superior to your own technologies becomes bigger, then the startup gap becomes bigger. Now, the relevance of the startup gap has increased significantly over the last decade because the amount of technologies that startups provide that is superior to what the incumbents have has really multiplied significantly. You can see this in the amount of venture capital out there. Last year, 600 billion, correct? That's probably about 10 times more than 10 years ago. But also the number of startups and also the, let's say, financial power of startups. I've seen that startups for specific concrete problems, such as, AI-related problems, have up to 30 times more budget, correct? So what that means is that you're looking at missing out a resource in large numbers in very relevant areas of your company that go way beyond R&D, correct? You're also looking at missing out technologies for manufacturing, for logistics, for your IT systems, for marketing, even for HR. And if you add up that you're missing technologies in all of those areas, that really means that you're missing millions and millions, probably hundreds of millions in benefits that you could harness if you would be using those technologies. Think about you're still using fax, and there's a startup out there that offers email, and you're missing that startup, correct? For 10 years, you'd be way behind in your communication efficiency. And this is just just to illustrate this startup gap.
Right. So you're saying there are certain problems that are clearly better solved in a startup environment than inside a large corporate, an incumbent company with all its benefits, but also with all its issues. And for that startup gap is really important for corporates to be aware of and try to keep, let's call it, as small as possible, or in an ideal world overcome, but at least not fall too far behind.
Yes.
Okay,
Yeah.
so this is interesting. That which obviously then is a very strong argument for incumbents, for corporates, to at a minimum try to get close to the startup ecosystem, but as you're arguing, without necessarily owning shares in those startups. Now, next, let me move on to the next question. We can double tap on that later on. So CEOs basically state that their target is very clearly to gain strategic benefits, not necessarily financial ones, via their CVCs. But CVCs, you say, does not really deliver the strategic impact. So why is that? Because, I mean, you said, well, owning shares doesn't give me access to the technology necessarily. But wouldn't an investor in a startup get a little bit kind of a seat on the table when it comes to development?
Certainly not. Just with desperate startups and the startups you don't really want to talk to.
Okay.
You gotta think about, the better the startup, the less likely it is that they allow any corporate to invest, because any shareholder has certain legal rights that may harm a risk for the startup to raise further rounds, for an exit, and even to acquire further clients. Imagine a startup that has investment from, I don't know, Audi. What would BMW think? Correct? Shall I buy this technology? Yes or not? So as soon as you sell technology, your shares to a potential client, you're also running a risk of scaring off the other market, because they may think, well, if that my competitor may, acquire the rest of the equity, so that scares off. And I've seen that happening many times. So that's a very important point to keep in mind.
Yeah. So now we try to kind of segregate the different models and look a little bit critically at some of the approaches that have been done for a long time in corporate venturing. So let's move on to the venture client model. So what is the venture client model? And tell me basically why you are such a proponent of the model, and then we can maybe circle back and have a look at some of the downsides of it as well.
Okay. So a venture client is a company or a person that buys and uses a product of a startup, and I call it venture client because if you're a client of a somehow unstable company, because its product may not be mature, because the company is not as mature, then you're running a risk that is bigger than buying from an incumbent. So, but the venture client runs that risk because the solution proposed by the startup is unique and the problem is relevant. So you basically say, okay, I really want that solution and I'm willing to run a risk because I would like to have that solution before my competition does, or if I'm a private person, before my neighbor has it, correct? So you're some kind of an early adopter, correct? That's what's behind venture client. Now the venture client model is so being a venture client is I just coined the term in 2014, but obviously venture client have existed for decades. I like to mention the example of Apple being the first venture client of Adobe when Adobe was in a garage. The first client or venture client of Cisco was HP. The first venture client of Siebel Systems was Charles Schwab, correct? One of the first venture clients of Mobileye was BMW in 2001, correct? So the venture client always existed and it plays an incredibly important role for the success of the private venture capitalist and obviously for the success of the startup, because the earlier you get a venture client and the better that venture client is, the faster you get revenue and the faster you get a great feedback. Now, if you're what I created now at BMW, and that's, if calling a venture client is maybe some kind of innovation on words, but what's really new is the venture client model, because what I said, what we need is specific processes, resources, and decision systems to be a good venture client. So not I happen to be in Silicon Valley and the VC, happened to introduce me to a startup, and I may make a deal with that company because that's really cutting edge technology, correct? Yeah. So it shouldn't be left to, there should be a system behind it, because only through that system you can systematically identify this gap, the startup gap, you can assess it. And from there on, you can really approach the startup ecosystem with the strategic intent to identify, what's really relevant for you in the startup ecosystem, and then in a very structured approach, close this gap. So that's the venture client model that I implemented, and then I developed this model at BMW, implemented it, and it's becoming pretty, implemented in various other corporations, and it works nicely.
Right. So basically, the corporate incumbent becomes a customer of the startup. So as you said, so there are two parts to it. Number one, obviously, that generates revenue for the startup, which is always nice. And secondly, it also allows the startup to work with a team inside the corporate that may help them to kind of polish that that incumbent product that they have presented. The product may not be, hence it requires a little bit of a different, what I would call, risk appetite from the corporate to dare to use a startup as a supplier, to become a client of that startup. But if executed well, it can really have fantastic benefits for both the corporate, but also for the startup, besides the revenue generation part.
Exactly.
Okay.
And one of the important things is that as you establish your venture client model, you obviously go through each of the steps of the relationship and you really think about, how can you optimize this? And for example, one of the important principles of the venture client model that I defined is that you should not approach a startup that needs your help. You need to look for startups who can help you.
Who can help you to address those questions, that you haven't been able to answer potentially.
Exactly. So it's not about the startup approaching a corporate and the corporate helping me with anything. No, you're the corporate. You need to solve a very important problem, and the startup is really there to help you, because that's the very nature of the startup. And that's what you learn, drastically in Silicon Valley when you start a company, because the very first question you get from every VC is, what can you do that Google, BMW, and Apple cannot do?
Yeah.
So they don't ask you, I'm going to give you money so Apple helps you with your product. No, they're going to ask, they're going to blow you away from the market if they can imitate what you're doing. So why should I give you my money? Prove to me that you have some kind of unfair advantage that none of those big companies has. And now I'm going to, hand you over, 15 million in a Series A. But if you don't have that proof, forget it. And if any CEO should picture that conversation of a big corporate in his head, and this is where they start rethinking how they approach startups, because it's really about, I need your help because you can do something supposedly that I cannot do. And that's why we need to engage in a relationship that goes, obviously, that's very much based on product and not on equity, because you already got a lot of money from a top venture capitalist. So the last thing you need is my capital, because you already have that, correct? What you now need is to prove that your product works in my company. So prove to me that you can really help me. That's how this thing needs to be approached.
Right. So let's go back where we started, the impact for the corporate. And you've mentioned BMW, you worked with other corporates as well. When you look back at your experience as the venture client model was rolled out or introduced, what tangible impact did it have, for example, for BMW? You know, how many startups were they able to connect with through the venture client model compared to their corporate venture capital activities, which at least BMW has as well in parallel to it?
Yeah. So yeah, I did this academic research where I looked at BMW with a venture client model and without the venture client model. And I even looked beyond when BMW had a CVC, because BMW had a CVC in 2011. But I looked as far back as 1995. So basically, I looked at how long did BMW between 1995 and 2015, what were the metrics around startup technology adoption? Okay. And I found one very interesting metric, which was before BMW had the venture client model. So it was just a venture client, but an unstructured one, an unprofessional one. They were using generic purchasing processes, generic evaluation processes. It took BMW 2.1 years from the first contact to the purchase order.
Okay.
And with the venture client model, it's below 3 months.
Oh, wow.
So
this is a drastic acceleration of engagement.
And then very important, I'm not just looking at corporate venture capital. I really looked at, because as I said before, BMW has been engaging with startups. BMW had an office in Silicon Valley since 98, for example. So they had engaged with Google before they went public. So BMW was very, a strong pioneer, but just in many things you do in life, as you do it more and more, you become better and better and more professional. So as I implemented that structure, that process in 2015, I saw a significant boost in the speed. I also saw a significant increase in the amount of startup technologies. And that was somewhere around a factor of 10. So being the process much more efficient, now BMW could scale significantly, almost exponentially, the amount of startups you can benefit from. Right? There's a little bit what happens with many technology, correct? Email versus fax, correct? How much communication that really increases exponentially your ability to communicate. So similar with the venture client model. What we also saw is a significant increase in the quality of startups. It's extremely important because obviously benefiting from a startup primarily also depends on the quality of the startup. So as a corporate, I won't make a startup better because that's not my role. My role is to make great cars or great whatever washing machines or whatever my product is. And if you measure the quality of a startup, a good indicator is its valuation. It's how much do they get in Series A funding compared to the rest. And so the average Series A funding was beyond 10 million. And they were all early stage. So, and what I saw before I implemented the venture client model is there are many startups that had no funding at all, right? Okay. And those startups obviously had a hard time, really delivering on their promise. So there were several metrics that really show, how, the impact the model had on BMW in being able to benefit from startups. Yes.
So let's take a step back in a global perspective, in the context of corporate venturing. And you had mentioned Silicon Valley a few times. I get the question regularly, Europe versus Silicon Valley or Silicon Valley versus the rest of the world. Let me ask you, what do corporates in Silicon Valley do better or so much better than those in the rest of the world?
They're much better venture clients.
Okay.
That's really what makes Silicon Valley work. If you are a startup and you get funding from, I don't know, Andreessen Horowitz, and you knock at the door of Apple and say, hey, I've got a great invention. Everybody wants to talk to you and say, hey, let's talk. What do you have? This must be unique. This must be something that we cannot do because, this venture capitalist just invested in you and not in 10,000 other business plans that he just shoveled aside. And that understanding, and now their focus is show me your technology. What can you do? What can you do? What's your value? What problem are you going to solve at Apple? What problem are you going to solve at Facebook, at Google, at Cisco, Intel? That's this culture. And then obviously the next step of this corporate is let's just buy and use your product. I won't give you millions, but I'll give you, let's buy a few units. Let's test them out. Let's put them into. And so they're really venture clients and a very intrinsically venture clients. And then the next step is they go into long-term relationship, which can be a partnership. Many times it's an M&A acquisition. So it's very important that the venture clients are the ones who purchase and acquire startups. It's not the corporate venture capital. So if you look at the structure of Silicon Valley firms, there is a Google Ventures and then there's a Google M&A. Those are different teams, different budgets. And the M&A department always talks to the client. Hey, should I buy this company? Dear engineer Joe, oh, yes, this is really unique. Why is it unique? Why can't you do this? Well, I can't do this because they have IP, they have patents, they have 20 people on that, and I only have 2. And they already developed a prototype using 20 million of venture capital money. They're much further ahead. They'll save me 2 years. Oh, and do we really need to own this exclusively? Yes. And have you used this technology? Are you sure that this really works? Sure. I've been using this technology for the last 6 months.
Because I've been a venture client, basically.
Exactly, you're a venture client. So this is what Silicon Valley does great. And now what comes out of that is that, startups become bigger faster. The bad startups, are eliminated faster, which is also important.
Sure.
And this generates a lot of wealth obviously also then through the acquisition. And now you have a lot of acquisitions and you have a lot of exits and IPO, and that generates that generates venture capital. Because if you look at the independent venture capitalist, that's all basically full of successful entrepreneurs. Look at Andreessen Horowitz, maybe as one of the best examples. So what really fuels the advance and the growth and the success of a venture client, of a Silicon Valley, is this venture client culture that exists in corporations that are headquartered in Silicon Valley.
Yeah, I mean, that's why around the world countries have tried to replicate the Silicon Valley model, because it ultimately, what you just described, is are real benefits to the overall economic health of a region, of a country. So this goes beyond individual companies and startups basically being successful. So yeah, it will be interesting to see how this will roll out around the world. Whether, all regions. You mentioned a number of the kind of record-breaking year that venture capital just had last year. Now, this was the case across the globe, obviously, but clearly the US was far ahead in terms of capital deployed. We will see how much can be learned around that. Now,
maybe I will make a short comment here, because
sure.
What governments are not seeing, and what they're trying to imitate Silicon Valley through venture capital. They should try to imitate Silicon Valley through venture clienting. Correct? So if you're country A and you think, well, I just need, a Kleiner Perkins in my town and I lower the taxes and what have you, then, a lot of money will flow, and this may generate more companies. But if companies don't have clients, they will die, right? So what you really need to do as a government that will have a much larger impact and leverage on generating a startup ecosystem is foster venture clienting. If you're the chancellor of Germany or the president of France, go to your companies and say, you got to be venture clients, and I'm gonna incentivize you being good venture clients, because this is what ultimately will generate demand for the startups, because there's enough global capital out there, correct? But what startups need is that fast, let's say, enthusiasm by good venture clients, not bad venture clients, because bad venture clients, they kill the startup.
Sure.
And by changing that focus, I think you can, and we're seeing this here in Munich, right? We have a bunch of venture client companies, and the demand for startups has really increased significantly since we have BMW and some other corporates here in Munich starting to adopt this venture client mindset.
Yeah, very good. Now, what do you recommend to a corporate parent who may want to start or who may want to get closer to startups, may have already dipped their toes into various models? What do you recommend as, let's say, 2 or 3 concrete steps to move in the right direction?
Well, first of all, they should get their mindset and their awareness and the head around the fact that it's all about product adoption. And the fastest way to adopt a product is to just buy it and use it and test it out, right? I think this is a very critical mindset. If they start with, I only speak to the startup if they allow me to invest, then they're automatically putting a bottleneck to innovation from the startup ecosystem. So that's number one. And here I would recommend, anything from, great classes at INSEAD to, I guess, inform yourself and speak to other corporates who have a venture client unit to see what impact that makes. The second step is now to identify 2 areas within your company that have the highest urgency for startups. Generally, you would pick an area that generates growth at your corporation in innovation, R&D, and another area that's very critical for efficiency. For example, manufacturing, where new technology can add immediately a lot of millions in cost benefits. And now with those basically 2 departments or 2 divisions or areas or business units in your company that would really benefit from startup technologies, now you got to set up a roadmap and plan to establish your venture client unit. And obviously here, I guess a good step is to start talking to other corporations who've done this and see, what are the steps they have taken in order to really establish, a solid, high quality process and venture client infrastructure.
Yeah. So thank you so much. Thank you for your time. So in defense of the venture client model, it was a pleasure to have Gregor Gimmy with me on a very interesting conversation. He heads 27 pilots, and we explored how corporates can successfully benefit from engaging with startups. And spoiler alert, it is not through corporate venture capital. Gregor, thanks very much. I look forward to having you back in class. Thank you.
Thank you very much.